Good afternoon. Welcome to our panel from the Harris School on inequality, debt, and hope for a better financial future. As many of you know, there are people that struggle every day in Chicago, and the COVID-19 will put more people in that category, but also the people that we're vulnerable for are more vulnerable than ever. So to discuss this today, we have Jennifer Tesher from the Financial Health Network. We have Marie Lynch, who's the president and CEO of Chicagoland for the just messed up the name here.
Skills for Chicagoland's future.
Future Skills, yeah, Future Skills. And then we have Dominic, who's with us from the PARA, the Public Employee Retirement System in New Mexico. So we're going to start with Jennifer, and Jennifer's organization's been around since 2004. They try to help people that are underbanked, people that kind of fall through the cracks, that don't have bank accounts, might not have access to retirement type vehicles. And she's partnered with major companies, major banks around the country in order to help bring these people into the mainstream of banking. And now with COVID-19, there are going to be problems beyond just that challenge with respect to receiving money from the federal government and those sorts of things. So I want to start with Jennifer talking about what your organization is doing with respect to COVID-19.
Sure, thanks for having me. It's always nice to be back, even virtually, at Harris School, and especially to be back with my colleague Marie, who she and I were classmates together. So thank you for having me. The Financial Health Network is a resource to the business community, particularly financial services companies, but beyond that, all around a mission of improving financial health for all. We define financial health as having a day-to-day system that helps to build resilience and pursue opportunity. So essentially manage against the downside and take advantage of the upside. And clearly we find ourselves in a very significant downside right now. One of the things that we do is gather a lot of data about the real financial lives that consumers face. Too many of the surveys and other data sets that are out there tend to focus either on higher income people, or they focus on averages and annuals, but people don't live year to year, they live day to day and week to week. And so a few years ago, we started a new study called the US Financial Health Pulse. We field it annually. It's a panel study, so we're able to get responses from most of the same people year on year. So it's longitudinal. It's about 6,500 people. We do this in partnership with the University of Southern California, who runs the panel. And we ask well over 100 questions, including the key indicators that we use to determine whether or not we think you're financially healthy. We've created a measurement framework and methodology around that, but also a whole host of other questions to understand what else is going on in people's lives. And we're able to then cut this data by all kinds of socioeconomic factors: income, age, race, ethnicity, geography, et cetera. It just so happens that we are in the field with this study during the month of April. And so when we saw what was happening, we were able to add several COVID-related questions so that we could really understand what was happening to people And again, we have the benefit of not just being able to see what's happening as a snapshot in time right this very second, but also to compare to how that person was doing a year previously. Now, I should just say that in general, as a nation, we're not terribly financially healthy. That only 29% of Americans in 2019 would we consider financially healthy. And another 17% we would consider financially vulnerable. And the rest, which if my math is correct, is I think about 54%, are coping, financially coping. And when you look at those numbers and you look at them by race or by income, people of color fare worse on average. Lower income people also fare worse on average, although financial health is less of a feature of one's income, although they're certainly correlated, and it has a lot more to do with broader financial behaviors. So going into the crisis, people were already, lower income people and people of color were already behind and facing challenges. And the crisis has absolutely hit these populations far more drastically. So, we know that through mid-April, workers in the bottom quintile of the wage distribution had experienced a 35% employment decline, which is almost 4 times higher than those in the top quintile. In our survey that I was just mentioning, that literally came out of the field about 10 days ago, so we're just at the beginning of analyzing it, a third said that their income had decreased due to COVID. 44% said their employer had reduced hours or pay. 42% worked less because of lower demand for services that they offer. And 34% were furloughed or were on a temporary leave from a job. We also asked people about whether or not they had received a government stimulus payment. Slightly over half of the respondents indicated that they had already received their payment at the time they took their survey. But when you break the numbers down, it tells a very different story. Among households earning under $30,000, only 37% had received their money. Whereas for households earning between $30,000 and $150,000, the percentage was over 60%, or almost 1.7 times higher. Similarly, households that were headed by a non-Hispanic white person were 20% more likely to have received their money than households headed by a Black person. Latinx households fared slightly better than white households. And then you can see that those who earn less than $30,000 are more likely to be using their recovery money, at least in part, to pay for food or medicine or to pay bills like their rent or utilities, relative to those with people making more money who were less likely to use the money for basic necessities. So why is it that there was such a disparity in who's received their government aid payments? Well, this is just another example of how the inequities that existed prior to COVID are really having an impact on people. The first people that the government sent their money to were people who had filed their taxes and on their tax return had put their bank account and routing number so that they could have their money sent to them by direct deposit. So that's about 80 million taxpayers. That leaves another roughly 70 to 90 million people who fall into another category. Most of those people who had filed returns, they didn't use direct deposit as an example. Or another 10 million of them didn't earn enough to have to file a tax return, yet they're still eligible for a payment. Or they don't have a bank account. Now, while only 6% of people in the United States are unbanked, those who make less than $30,000 a year have an unbanked rate of 17%. That's 12 million people. So for all of those reasons, the people who need the stimulus money the most are going to get it the slowest. They're going to be the last to receive it. Another inequity that's worth raising in this moment is the digital divide. It's easy to think that the digital divide doesn't really exist anymore because it feels like everyone has a phone, a device of some kind. And that's true. Even by income, rates of of smartphone access are relatively high. But the big issue that we've now been reminded of, given that we're all stuck at home, is internet access. So while 90% of Americans say they use the internet, only 73% have broadband service in their homes. And only 56% of people earning less than $30,000 a year have service in their homes. When you're able to go out and go to the library or your kid's school, or maybe use the computer at your workplace, we don't have to really think too much about the disadvantage that comes from lack of broadband access. But when we're stuck at home, all of a sudden it becomes clear. And this is especially true as it relates to schooling, now that kids are having to do school virtually. So for instance, about 20% of the children in Chicago live in homes without the internet. And in some minority neighborhoods, up to half of the children can't get online. Imagine having to fill out an unemployment insurance form of some kind to sign up once you've lost your job on a tiny screen of your phone with only cell phone access, if that. And imagine that you have a very limited number of minutes because that's all you can afford. So even if you wanted to use the IRS website to give them some direct deposit information so that you could get your stimulus payment faster, you need the internet to do that. So these are just some of the ways in which the COVID crisis is really exacerbating the existing inequities that we're all familiar with. And if we don't focus on these things now, people are going to fall even further behind. So I'm hopeful that in the recovery that we'll think about all of these challenges and use the rebuilding time to address some of these issues.
Excellent. So now we're going to turn to Marie, and she's the president and CEO of Skills for Chicagoland's Future, came out of the mayor's office, and one of the key initiatives here is to match people that are unemployed or underemployed with employers, providing some support for developing skills. And now we know that there will probably be less employers available and more unemployed. So your organization faces a big challenge, and we'd like to hear about your thoughts on that.
Yeah, thank you, Mike. And thanks, Jen. It's fun. This is like the old days when we used to do our group projects. I feel like I'm back in when we used to sit in each other's apartments and do work together. So fun to see you, and nice to see you, Dominic. I think one thing I just want to start by saying is, to folks on the phone is one thing you're going to hear, I think, a lot. It was actually interesting to listen to Jen, because I think the data aspect of what we all learned at Harris is going to come through and seep through all of our presentations today. And you're going to hear that again. And I think Jen did a really nice job of explaining kind of the big picture on this of what's happening in the income side. And I'm gonna put some exclamation points on that. So let me start by just telling you a second about skills, and then I'm gonna pour into some data. Just for some context, I actually founded the organization back in the last recession. So it's very interesting to me to see 10 years later what we've been able to learn from the last recession and what happened, and then what is so different about now, which I'll be happy to talk about as well. It's also crazy to me that it's been 10 years and I can reflect on it that way. But in any case, there's, this moment is certainly unlike the last recession in a lot of ways, and I'm gonna share some of that. So let me pull up some charts here to show you some things. Okay. All right. So at Skills, what we work on is we work with about 50 employers to put about 1,300 unemployed into jobs every year. We also have an affiliate site out in Rhode Island. And so we have the view of actually seeing what's happening in a couple places. But as you know, right now, when you look back, and this chart is basically showing you back, going back all the way to 2000, and then you can see the recession here in 2009. These numbers, as we know, from reading, are just astronomical, right? I mean, these 36.9 million in the United States is just nowhere near anything that we experienced historically. I would also add that in Illinois, the unemployment claim is over 1 million. And as I poured through some old data, I remember talking a lot during the recession about how there was roughly 200 to 220,000 unemployed in Cook County, and at the time there was roughly 130,000 to 150,000 jobs. Right now, we're waiting for the Cook County numbers specifically to come out, but maybe figure there's somewhere between 500 to 600,000 unemployed. And in terms of jobs, I mean, those numbers right now are, way below 100,000. So there's a very big mismatch that's happened, and that's much larger than before. Go to the next slide for you. And I don't mean to, this is a lot of bad news, but we are going to try to get to some of the good news. But just to put an exclamation point on, again, a lot of what Jen had said, I think, some things to note here is that I think this is a really interesting some data that came from Deutsche Bank, which showed that, basically that the number of jobs lost in the first 4 weeks of this basically took away anything that had been gained in terms of all the jobs that had been gained since the last recession. And so, again, we know just how significant this is, and these job numbers just continue to increase. Also, Jen did a really nice job of talking about the impact on different populations. And let me just tell you a few things that are happening on the job side. So as we're talking about, I mean, the inequity gap, the inequality gap just continues to grow, and that, those who had the lowest wages were part-time or hourly workers are those who are most impacted by this moment. The job losses also hit the youngest hardest, as well as individuals that are African American or Latinx. Additionally, workers without a bachelor's degree are 2 times more likely to be vulnerable, and we continue to see that. You can see the stats that come out regularly. If you're making under $40,000 a year, 40% of those individuals right now are without employment. So if you were, again, as Jen describing, if you were struggling to begin with, this impact has been really, really devastating. And certainly there's individuals now who have bachelor's degrees or some college who are affected, but again, those with only a high school degree are much more affected, and those who had the lowest income are the most affected. The other thing, again, I don't mean this to be all bad news, but I think it's also helpful to look at, and we would expect this, but as the number of unemployment claims has gone up, the number of job postings has gone down. We know that. We expect this, this is run through, just the first month of COVID here. But it's, it's really interesting to see also that, greater than 50% of the decline came in non-essential retail. At Skills, just as an example, we talk to our employers on a daily basis, and on March 15th, 55% of our companies had been hiring had stopped hiring. Now, on the flip side, there's also a number of companies which started to hire. And I think that's important to note too, right, is, this was kind of immediate in the March, but there are definitely pockets of industries and companies that are hiring. And so for individuals who did want to work, and by the way, I want to note that, there's of course many individuals who cannot work because of childcare issues, cannot work because of healthcare issues, may not want to work because of healthcare issues. But there are some individuals who want to work, and, this gives you a sense of, anything related to any type of cargo or freight or any type of movement of product and food. Of course, there's a number of jobs with that. As you'd expect in the financial sector and some banks, loan interviewers, remittance processors, there's jobs associated with that. Healthcare, of course, had a series of jobs associated with that. So there were pockets of it, if somebody wants to work. But again, I would say the other thing that happened is there certainly was also this kind of mismatch happening in terms of, it took a little bit of time, I think, for companies to start to get their PPE equipment up and ready and to get their safety precautions up in a place that was, made it comfortable for individuals to come to work. That being said, when we look ahead, this is a chart we put together at Skills, is we are expecting what I'm calling waves of unemployed. So let me just orient you to this chart here. This may be this is like Harris all the way through the way we think about these things. But if you look at where we are here in May, which is where the red says we are here, we knew there was the first wave of layoffs. I think you started to see there was a second wave of layoffs that happened as people had, initially the companies had furloughed, and then companies, I think you started to see it the last couple of weeks, started to actually announce that this furloughs were turning to layoffs. While the stay-at-home order will lift, some point in June, July, whenever that comes, we do expect, just as Jen noted on the digital divide, we are seeing that. One thing folks may not realize, I just want to take it a step further, is you actually cannot apply for unemployment on your phone. It's not possible in the state of Illinois. And we are finding with youth that the digital divide is, because of exactly what Jen talked about, the internet issues, is extremely difficult. So whereas a lot of folks have been able to shift and do things virtually, there's an entire segment that is unable to do that, which is why these waves of unemployed are so important, because there's an entire set of people who may be interested in working or going back to school who just don't have the ability right now to be able to access that. We also anticipate, we know that federal unemployment extension, the additional $600 a week, right now is set to end around July. It is important to note, it is true that there are a number of individuals right now who are not seeking employment. And again, it may not even be because they're concerned with health, but it's because there is a group that is actually receiving more funding right now than they were in their hourly or part-time jobs. That is true. That is happening. The good news about that, I think, is right now, even if those folks were to look, there's not enough jobs for them that's available. So it's a really healthy benefit that exists. But once that ends, if that doesn't get extended past July, we anticipate another wave of unemployed will hit. I would also say that there has been a series of what I'd call temporary COVID-19 positions. We've been working on that too, everything from homeless shelters to, the McCormick Place, to some of the healthcare buildup that's happened, that we anticipate, some of the food aspect that we expect those jobs will start to, decline, and then there'll be another set of folks in the workforce. Meantime, the other piece I'd mention to you is when the airline federal stimulus ends in October, the airlines have already talked about how there will be a lot of those individuals will be turned into layoffs. And then the state unemployment extension right now, it's 39 weeks. If they don't extend that, that will then hit around January. So, what does that mean? These blue layers underneath just to give a sense of, I always go to so what do we do with all that? That all sounds pretty tough. It is, but I would say that there's, we are anticipating, industries that will come on board, right? And roles, contact tracers is an example, right? There are going to be aspects, sanitation. There are going to be aspects of the work there's going to be pockets that return. The industry will come back. Industries will come back at different levels, but we do anticipate in this dark blue that there's going to be a very large group of unemployed who's, there simply is not the jobs for yet as industries come back. And to add to the, the financial health issue, this is a group I know Jen and others are very worried about, and we are as well, when there's not enough jobs for these individuals. So that gives you a sense, I think, of what we are anticipating. That being said, I think, Chicago is an incredibly philanthropic community. There's a number of folks working together. I'm actually part of a group of 16 other CEOs in the workforce group. We get together every Monday where we put together some plans on how we think we can start to tackle these waves of unemployed. And I think it'll be innovation in the public and the private and the not-for-profit sector, which will help us get through this moment. Thank you.
So now we're going to turn to the public sector employment. Dominic Garcia is the Chief Investment Officer of the New Mexico Public Employee Retirement System. And so one question will be dealing with losses that came from the market. I think there was about a $16 billion loss, and then how there might very well be government layoffs, so there's less money being paid into the system, and then of course, how will retirees fare with this? So if you could give us some perspective on that, Dominic.
Sure, thank you. So it's a pleasure here to be with you, Mike, and with the Harris School. I appreciate the opportunity. Just as you mentioned, I manage the assets for a $15 billion pension. And we have a defined benefit system, which means that a public sector worker, so we serve about 90,000 public sector workers here in New Mexico. Those are everybody but teachers. So if somebody retires, works for 20 to 25 years, the day they retire, they have a pension benefit for life. In addition to that, we manage about $600 million in defined contribution assets, which are kind of the equivalent of 401ks as well. Just to give some perspective of what the defined benefit pension means to New Mexico, we pay out about $1.2 billion in benefits to retirees annually. For a small state like New Mexico, that's about a 2% of our GDP. So just some really simple things that have been occurring during COVID, obviously, is everyone's trying to be mobile. But March was an interesting month in the capital markets. So in the capital markets, quite a lot of things froze up. For us, luckily, we had some strategies whereby we maintained a very high liquid portion in our portfolio. So what was very critical at that time was continuing to pay out benefits and keeping the lifeblood of liquidity in the portfolio going. So that was a key thing that happened for us, at least in COVID. But as Mike mentioned, there's a broader thing I want to talk about, which I think Jennifer was talking about, which is the financial security of folks, and I'm going to highlight really retirement security. So I'm going to say broadly, when you think of retirement security for anybody, public or private, the rule of thumb is that you want to replace about 70 to 80% of their working income. Social Security covers about half of that. Our retirees that come out of our system, we're replacing upwards of 80% of their income, and many of them we're replacing about 100% of their income. So when they come out of our system as a retiree, they're doing fairly well. But I want to talk more about this retirement security issue. Pre-COVID nationally, I think everybody knows, as Jennifer was touching on, is that 21% of Americans had no retirement savings whatsoever. Less than 10% had like 5,000, and about a third of baby boomers, right, who are about or are in retirement, have less than 25,000 in savings. So what you find is that pre-COVID, there was quite frankly a retirement security crisis before things hit. Now, and I think that's both public and private. More specifically on the public side, I think what you'll find is that many public pensions across the country were about a 70% funded ratio, which means that there was about 70% of assets to liabilities ready to fund retirements in perpetuity for folks. But if you actually pulled the onion back a bit, that was actually a little worse. What you actually find is that the cash flow and the needed cash flow for those pension funds was actually in a more difficult place. So here in New Mexico, what we did pre-COVID was that we did a pension reform here that just passed our legislature and was signed by our governor here in late February. And what that did was that reformed our pension in two key ways. One is it increased our contribution rates closer to the actual cost to pay for benefits. And second, it reformed our the way we pay out the COLA to our retirees. It tied it back to the investment returns that we get in the portfolio, instead of giving a compounding, consistent, fixed COLA that's not dependent on any returns or anything in the marketplace. So for us, that was a big deal. Pre-COVID, it got done just as late February, so maybe call it just in time. But what that does is that sets our system up on a very sustainable path to weather even these storms. But I would have to say a lot of public pension plans around the country don't have that benefit of sustainability. So that's one thing that I want to touch upon is now kind of post-COVID. What do things look like for retirement security, both in the private sector and in the public sector? As I mentioned, in the private sector, folks are just not saving enough. And what you're finding now is private corporations are actually suspending matches on 401ks. So if any savings that were happening pre-COVID, it's even worse now post-COVID. Not only for unemployment, but those that are even working, you're seeing the 401k matches being reduced or gone altogether. And I'm doubting that many folks, whatever savings rates they had prior to COVID, have got to be, I haven't seen any data on it yet, but they've got to be reduced, if not zero, post-COVID. Now, for public pension plans, as I mentioned, I think particularly those that are lower funded, 70%, 60%, 50% lower funded, I think this is just going to exacerbate their issues. And so I think the first thing is most of those public pension plans around the country, the reason why they were in an unfunded situation was their sponsored governments were not paying the right rate to pay contributions into the plan. Post-COVID, as everybody knows, budgets have been strapped a good 20 to 30%. Contribution rates, the pension plans are going to be even more strained as they were prior. And in my opinion, if state and local governments pull back on those contribution rates, it will create an unvirtuous cycle. Meaning, if you lower those contribution rates into your public pension plan, your funding ratio goes up. The liabilities that you have to cover are mandated generally by law or in Constitution. That's not going to stop growing, but the assets to pay those off will go down. And so what ends up happening is over time, if you have that unfunded liability continue to grow, you're going to see pressure on state and local governments' credit ratings, their ability to issue debt, et cetera. So I think what's a key piece for public pension plans going forward and for governments is to make sure that they maintain those contribution rates. I know that's going to be a hard fight, but I think that's a key piece. The second is there's even more vulnerable plans in the country. Those more vulnerable plans that are 30, 40% funded, those plans are going to face some potential hardships and are going to be facing asset exhaustion at some within the next decade or so, and they're going to be looking at those types of stats. And so for those plans going forward, it's going to be a tough road to hoe, and there's a significant amount of them around the country. And I'll cite something if anybody's interested in this. Boston College, their Center for Retirement Research, they have a very good, first of all, it's a very good center. But second is they just came out with a new report that talks about the most vulnerable public pensions and their rate of asset exhaustion. So I'd highlight that to anybody who's interested. And then the last thing I'll touch upon is for public pensions, is that all public pensions to finance that benefit, that lifetime defined benefit over time, they need to be financed anywhere around 7% returns over time. So those contributions that come in are then reinvested at a rate of, call it 7% to pay off that lifetime benefit. For us, our assumption is that we have to generate about 7.25% to generate that benefit and finance it over time. Now, what happened in the capital markets is, well, we saw a drawdown over the last quarter or so. There's maybe some good things and some bad things that happened out of that. First is there always are opportunities out of crisis, but two, expected returns are probably a little better going forward. But I think the third thing that I want to highlight is that the return on capital in general just went down. So, and what I want to point out is pre-COVID, if you invested in the capital markets pre-COVID for the last 30 years, your expected return on cash was about a 3% return. And if you invested in just a simple 60% stock, 40% bond portfolio, you received about a 5.6% return out of just that over cash. So if you put your cash return plus your stock bond return together, you generated somewhere around 8 to 8.5% return 30 years prior. Now, the big challenge for folks like me, chief investment officers or asset owners of big pension funds, the big issue is that cash is now at zero. So that expected return that you would generated on cash in the past, that averaged around 30%, is now at zero, and it's probably at zero, just a lower for longer rate environment, as the Fed continues to kind of help spur and stimulate post-COVID. So what that means is asset owners need to find 3% returns to help finance these benefit and these liability structures. So that's the challenge from a chief investment officer, asset owner, is generating that total return when cash is low, and secondly, ensuring that the contribution rates that need to go into the pension system continue to go in. If not, those unfunded liabilities that are mandated to be paid out over time, those will continue to grow. And I would argue that can create an unvirtuous cycle in the public pension industry. So those are the challenges. I don't think all hope is lost. I do think there are some solutions, and there are some creative ways to generate that return that's necessary. It's just going to be different. It's going to require folks to think differently, to act differently from what we did pre-COVID. But I'm happy to speak more about that if necessary. So with that, I'll pause and turn it over to the group.
Great. So I'm going to ask a couple questions and then of each of the panelists, and then we will open it up to the audience. So one question I have for Jennifer is, you had written an article about, and you touched on a little bit, that the people under a certain income level don't even file their returns, so there's no way of them having a connection with the federal government with respect to getting any of the COVID support money. How does your organization deal with that? I think you're on mute.
Sorry about that.
Right.
So things are moving pretty quickly. And so this has been dealt with in a few ways. So the first thing the government did after hearing that this was going to be a problem is that for Social Security recipients or other federal benefit recipients that don't file a tax return, they were able to send them their payment through their existing benefits card or through their existing direct deposit relationship they have for getting their monthly benefit payment from the government. So that took a nice chunk away. But then there are the people who don't get any benefits and who make less than essentially $12,000 a year. And when you think about who those people are, they're homeless people. They're, frankly, a lot of single men and single men of color, because the asset limits, the income limits and asset limits are such that those are folks who don't often qualify for other benefits, even though they're very low income. There's been a lot of talk about trying to help get those people connected through state programs, like maybe they're receiving SNAP as an example. And that would have required the federal government to do a lot of file matching with states. I don't think that actually ever happened.
Yeah.
There was then a lot of work on the ground with community groups to try to identify those folks and help them get on IRS's radar screen, and either by filing a return. So I do think that there are going to be people left behind who would have qualified, but are just either not able to apply, don't realize they could, and but even people who do qualify and who have done all the necessary paperwork, et cetera, are still waiting for checks.
Yeah.
So, it's going to be, another month, I think, at least, if not two, before all of the payments are out.
Okay. And you had suggested that maybe out of this crisis, there would be some opportunities then for reform because it shed light on the problems.
Right. So it feels to me like when someone is getting a payment from the government, that they should automatically be opted in to some sort of disbursement mechanism.
Okay.
We can talk about whether that's a bank account or a prepaid card, how that gets created, what the features are. We can have a lot of conversation about that, but it feels like it should just be a given.
Yeah.
The federal government has done an excellent job of this as it relates to people who receive federal benefit payments. Like I mentioned, Social Security, disability, veterans, retirement payments. About 10 years ago, they created the Direct Express program, and they said, we're going to phase out checks, and you either need to have direct deposit through a bank account, or we'll give you access to this card. And today, something like 4.5 million benefit recipients use that card. The rest use a bank account. And the direct deposit rate for those payments is somewhere near 98%. They've had dramatic success, but they have not been successful in using that program to issue one-time payments like a tax refund.
Mm-hmm.
There is another government program called the U.S. Debit Card program, and that's for a bunch of other, like if you're leaving a federal prison, you're going to receive this debit card, and it's going to have the money on it that you came into the prison with. So there's a variety of other use cases for that program, and that would be the program that it would make the most sense to use for one-time IRS payments. And I am quite hopeful that what's happened with the pandemic and these stimulus payments is going to solve that problem once and for all. The real issue is if we want that to happen, they're going to have to change the tax form.
Mm-hmm.
Because right now the tax form just says, give us your bank account and routing number. And if you don't do that, they send it in the mail. But if you want to enable someone to enroll, you're going to have to give them a checkbox like, yes, I want a debit card. And there are other issues. The system that the payment system that U.S. debit card uses is not the same as the system that the rest of the government uses. So there's integration issues, but none of these are impossible challenges. They're just an issue of will. Yeah. And particularly given the fact that we've had so many natural disasters where getting payments to people quickly is a challenge unless they have direct deposit or some kind of card. And given climate change and the fact that we're more likely to see more of these kinds of natural disasters in the future, there's a lot of reasons for the government to want to solve this problem once and for all.
Yeah, and it makes sense too that if you're going out and trying to get a check somewhere, you're now not sheltering in place, so you're vulnerable.
Right. Well, that's exactly right. If you're receiving a check, then how do you get the check cashed? Do you have to pay to have the check cashed?
Right.
Et cetera, et cetera. I do feel like, there are so many small little, what I would call plumbing issues that we don't tend to think about that really end up being huge obstacles for people. And this is one set of them.
Okay,
Another one would be if you are a SNAP recipient, now you don't actually get pieces of paper or coupons anymore. You get a debit card, which seems like a great advancement, except that if you want to know how much money is left on your card, you can't actually look that up online. You have to call a phone number. So one of the companies, we invest in early stage startups. One of the companies that we invested in, Propel, essentially has created the check your balance online service, and then has wrapped around a whole host of other kinds of benefits and services to that population.
Okay. So one just quick question before I move on. So your organization has partnerships with some large institutions, Citi, Bank of America, et cetera, Capital One. Are they, have you been in touch with them? Are they gonna be in a position to continue to support your efforts, given their challenges?
Yeah, I think that the biggest banks are not the ones we need to worry about. They're extremely well capitalized. They're in way better shape than they were 10 years ago. I do think that smaller banks and credit unions may ultimately find themselves challenged. But you know, the impact on the financial services sector, in a way, hasn't even yet been felt. Right. So aside from them having to bring everyone home, which is a huge challenge, you know, a lot of people have now been given forbearance on their loans. The real problem is going to be in 3 months when the forbearance is up and people are supposed to be able to make good on the whole 3 months worth of payments, which is not going to be possible. And that's when we're going to start to see the need for loan modifications, a range of other things. And that's when it's going to start to feel a little like the last financial crisis in terms of the need for lots and lots and lots of people to be providing direct customer service to customers to help them deal with their various loans. Again, the difference is the banks are extremely well capitalized, and but they're not going to really start to feel the pain or really understand the implications of the job losses on delinquencies and defaults until late summer, early fall.
Okay, thank you. So I want to switch to Marie now. You know, the picture you painted with these graphs, one is, it seems to me that your caseload's going to really explode. How will you get support to handle that? Mm-hmm. There are going to be more people unemployed that will need training, and there are going to be less opportunities.
Yeah. So the way we're thinking about this, because it's a little different, again, than it's a little different than the last recession when there was more of a mismatch and there were closer numbers, is a few things. One is, first, we're looking at, we're certainly, and somebody asked us in the question box, but we're certainly looking at the industries and trying to map out which industries are going to come back when, and trying to queue up groups, you know, based on industry and roles. And so that information is just starting to emerge. You know, as an example, you know, we anticipate hospitality to be one of the last, right, that will return. Right. Somebody else asked a question about, you know, contact tracers. You know, that is going to be a very large group that's going to come in, which I think will be a good match for some. But in response to your question, what I'm trying to say is that, yes, I think there will be some jobs. There will be jobs, right? And we fully expect also that temporary jobs will be the ones that are going to come back quick. I think employers are going to be, based on what we know from the last recession, they're reluctant to, I mean, they're going to bring on their own people first, but once they get past that, they're reluctant, you know, potentially reluctant to bring on full time. So we expect temporary to be a big pull again as things return to normal. But I think it's also going to be, we're looking also at, we're actually kind of trying to look at the macro numbers, and we're saying, okay, there's going to be a certain group that'll be able to go into full-time jobs, a certain into part-time jobs, a certain into temporary jobs. But then we also think, especially for the youth, this could be a really good time to go to city colleges, to go to your community college, to get your degree, to start to do that, because for certain industries that are going to take a while to come back, that may be a good time to get that. I think another grouping will certainly be around training. There are a number of different training programs, and I anticipate those will grow. I anticipate that there'll be funding, governmental funding, which will come to increase that. I think the earn and learn models will come back. Again, there was some of those. I think there's going to have to be things to kind of buy some time to get people credentialing, because there's just simply not going to be enough jobs. Now, all that being said, this is all markedly dependent on, the economy and what comes back. But yes, I think the wave is going to exceed the capacity of the workforce systems, not just in Illinois, I think everywhere. And so I can at least speak for here in Illinois. That's why a number of us are working together and talking to the philanthropic community about what type of philanthropic in the city, about what type of things we can be doing together to prepare for this. I'd also put one other layer on top of that, which is we're also trying to anticipate transit habits. And so, for example, we know that people are going to be reluctant to get on transit for a while. This is like a big citywide issue, everywhere. And so, being in the neighborhoods is going to be even more important, to be close in proximity, especially for those, again, who don't have the internet access, as Jen described. That'll be really important. So we were, as an example, we've been talking about as a number of not-for-profits, some hubs across the city and neighborhoods to be able to be there and present for when people start to come out of their homes and start to look. So I think we're going to have to do our work differently. And one other thing I'd mention is, certainly being close to the employer is really important. Skills started out, back in the last recession because there was this gap, and they're definitely, one of the things that I'm very concerned about, but also hopeful for in terms of, what we do is, who matters a lot all the time, but it's going to matter even more again, because employers are getting so many people applying for jobs. It's impossible to go through all those, all the folks that have applied. And so this is where relationships, like we have and some other organizations have with the employers, is going to be important to be really in there with those employers to make sure that those who most need the jobs are getting it, not just those who have the context and the relationships to get them to the top.
Yeah. Do you, so you're mentioning the philanthropic community, city. Would you envision the state or the federal government moving to some sort of New Deal type of program?
Yeah.
Putting people to work we still have this huge infrastructure gap in this country. Is that sort of thing being discussed?
Yep, and I can see Jen is shaking her head as well. I would say, so again, I mentioned that there's 16 of us CEOs of the workforce, of different workforce organizations here in Chicago, and we've actually been raising that to the state and to the city and to the federal level, because we do anticipate that there's going to be WPA type of projects that are going to come our direction, and that'll be a great opportunity at a macro level to get a number of people engaged. So yes, I think that's there's definitely more than rumblings about that, but in terms of that being passed in legislation, and that time will tell.
Okay, thank you. So Dominic, you laid out a good explanation of state of Illinois. Having very low funding ratios and very high, because of that, very high payments, and the payments crowd out a lot of these basic services. And what you described is that this is just going to get worse because the value of assets has gone down, and so contributions will likely have to go up. What do you if you were running Illinois' pension fund, what would you be doing right now?
Boy, so I think the best answer I can give is to take a step back and really see those that are running a public pension really well, what are they doing? And can we take some best practices away from them? And would that help the situation in Illinois? And that's kind of what we've done here in New Mexico. So let me talk about those broadly. So the first thing I think is having a flexible benefit design. So I don't know the Illinois, the Chicago pension benefits too deeply, but broadly I think what's important is that there's always a base benefit that people get. The day they retire, they're expected to receive a check for until the day they die, and then predominantly most pension systems offer an increase or a COLA up above and beyond that. I think what's important is that pension design, that benefit that you have, has a flexibility to it that can adjust to the economic realities or the investment realities of the world. And so that's what we've done here in New Mexico. We've adjusted the paying out the COLA based off of whether or not we have money to pay for it from the investment returns. So that's the first thing I would say is there a way we can make this pension design a little more flexible, but yet maintain the promise that we've given, right? I think that's number one. Number two is governance. And I can't talk about this enough, is if you study public pensions around the world, and there's broadly kind of three governance models or board models that kind of that rule those pension systems. One is there's a board that's predominantly professional based, expert based. There's one that's politically appointed, and then there's one that's elected by members, right? Those three models predominate, and then obviously there's a mix. What you find over time is that if you have more professionals, more experts on that board,
right,
the difference in what you receive in your asset return relative to those other models, it's about a 1% return over time, and you've seen that in academic results. 1% over, let's call it a 10-year period, that's billions of dollars, so that's significant things. So that's number two, I think, making sure you have your governance right. The third thing is, I know in COVID, I know now that a lot of budgets are strained. People are going to look to cut costs wherever they can. But in a public pension or whatever, an important organization, I would say any organization, the value of people is even greater today, right? And the people that are good, smart, willing to roll up their sleeves, take on the stress of paying out billions of dollars of benefits, you need good people in there. So it's not that you need to, it's not cut salaries, it's actually maintain or increase salaries so that you can recruit people. So I think if you can go in and change the flexibility of the benefit structure, get some better governance expertise on those boards, make sure you keep good people there now to come up with solutions and implement those solutions for continuity, I think that is paramount more than ever. Now, in terms of contributions, I would argue that turning off contributions in an Illinois system or any other system that's distressed is probably the worst thing you can do. It'll continue to, your liability structure will inflate, and it'll crowd out. We're talking about infrastructure. I agree with infrastructure as a boon to things, but if paying out to your pension system crowds out those other services, you're not going to get the benefit of that velocity of your dollar. So I would argue that all the above strategy that I just mentioned are things that you need to be done of any public pension system that's looking for a turnaround. And does that happen in 1 year? No. Does it happen in 3 years? Maybe 5 years. And I think you start getting in the right trajectory. I think the other hope is, by and large, I think this is a 10 to 15 year kind of challenge, right? We're still dealing with some very difficult demographics, but I think 10 to 15 years from now, those demographics improve quite a lot, and pension systems will kind of self-correct. So it's, can you build these solutions over the next decade that can manage through kind of the tough time over the next decade, and then after that, things start to self-correct. But I would highlight, it's a little broad brush that I gave you, because I don't know specific issues in Illinois, but I could think twice and probably give some more specifics. But flexible plan design, better governance, keeping good people, And then we can talk more deeply about portfolio solutions too, if you want as well.
So just to follow up to that, first of all, Illinois is very constrained. They can't do a lot of those things because of their constitution that you're describing. But I did want to ask you about the CARES 2 Act. There's concern about places with problematic pensions will take that money and make their pension payment really. It should be for revenue replacement. And where would you prioritize that if dollars were coming in, if it's not specified, if you're just for the state and saying that you're not going to put it towards pensions, a place like Illinois, for instance, what would be the services that you would prioritize?
Well, first of all, I would argue that pension contributions and paying down your debt and your public pension should be your top three, and at most top 5 priority. Where else would you put it? I like the idea of, quite honestly, if we're looking at stimulating economies, etc. To me, I think the best way to stimulate is straight transfer payments. So in some form of transfer payment back to the end user, just like how the federal government did that. I think that's the biggest use. That's the biggest bang for your buck. You get the most velocity out of that. So creating some kind of form of that, whether it's a diluted universal basic income, that kind of thing, where it's a transfer payment directly to the end user, which is the constituent. I would prioritize that. And by the way, pension systems are probably the most efficient transfer
Right.
system payments in government, right?
Right.
We get $1. Actually, the end benefit that the retiree gets, 30 cents of that was paid by contributions. The remaining 70% was through reinvestment income. So here in New Mexico, about 90% of our retirees stay in our state. So I would argue that that's the best transfer system government has,
Yeah.
period. And so maintaining that is crucial in whatever state you're at. So beyond pension systems and transfer payments, I would say the third best thing is infrastructure. But one thing that I've seen about infrastructure, in the way, I don't want to get into politics too much, but most of that gets pushed off into decentralized into smaller projects. I think it needs to be centralized into large projects that are going to be focused on the future economy, not the past economy. So things like energy transmission, things like water and wastewater, big projects, not decentralized small projects all over the state or all over the city.
Great. Thank you. So let's open it up to the audience. I have, let me see, from David Kennedy. If we know people who are in the situation Jennifer describes, how can we advocate for their 1200 relief check? I am in DC. My rep is Eleanor Norton Holmes. Would her office be able to help? So I would say that's for Jennifer.
I don't think it can hurt. The IRS had created a portal where you could go in and give them your bank account and routing number if you hadn't filed a return, or if you had, but you hadn't listed one. That portal was supposed to close last week. And so at this point, it's not clear to me how else one can make oneself known to the IRS, with the exception of filing a 2019 tax return. I should have mentioned this earlier. A really good resource, if we weren't sheltering in place, would have been the VITA programs, the free tax prep programs that exist all around the country. We have a very strong platform for that here in Illinois. Most major cities have that. The problem is it tends to be in person. I know some VITA programs have been trying to figure out how to do their work online, especially since the taxes they're preparing, they are using software. But talking to the local organization in your community that does that work, that you might find a solution. I would also say that TurboTax, H&R Block, all the major tax preparers that have online tax preparation software also have a free file version for low-income people, and they make it extremely easy to file. So that would be another way. If you know people who should qualify but don't typically have to file a tax return or haven't, that's probably the best way at this point to make sure that they don't lose out.
Great, thank you. And this is from Brendan Hogan, and this would be for Marie. There's been a large call for contract tracers in recent weeks. Will the hiring of contract tracers be left to the devices of local public health departments and community workforce organizations? And then similar to a question I asked is, has there been any murmurs of a 21st century CCC or TBA?
Okay. So I think I answered the second one earlier. In terms of the contact tracers, I think right now what we are seeing is that it's going through the state and the city. And yes, workforce organizations are, coming together to as more information is coming out to be ready for that. Just as an example, on ourselves, even though they haven't officially, the city and the state hasn't officially, given those specs to organizations yet. We, like, for example, we have kind of a vanilla rec up as we're trying to build the pipeline as we anticipate it's coming. And it's just a matter of how quickly it gets turned on. So I think there's no doubt it's going to happen. It's just the mechanics of it are coming still.
Great. Then we have seeing a third question. Let me see. I saw a question about this for Dominic about is this, and this is true in anytime there's a downturn or unfunded pensions liabilities, is there going to be a incentive to chase yield, riskier investments but higher yields?
Yeah, I mean, I think there's a couple of ways I could answer that. Is I think on the short run, there's opportunity and kind of dislocation and distress. So that's one. But two is long term. So if you think 10 years or longer, our pension plans, how do they see being able to meet their financing hurdles, right? And if I mentioned in my opening remarks that those financing hurdles, that the total returns in capital markets probably went down because cash is now zero. Is there an impetus to take on more risk and more risk via equities, high yield, whatever that may create itself? I think there's a potential for that. Now, however, I think what really is the key is where's the health of the pension system. So I think pension systems that are 70, 80, 90% funded, I think they'll just maintain. They don't have a need to take more risk. They might do that opportunistically, but for over the long run, they won't. Folks that are lower funded, they may. But I think, and this is really getting into a portfolio discussion. I think when pension plans, if they do choose to take risk, I think there's two avenues you can do. One is you can just risk up and buy more high yield bonds, buy more equities, or you can take a little bit more sophisticated and a little bit more complex route of being more diversified and using different tools in finance, active management, those types of strategies to get to your expected return over time. Now that's a challenge. That's more complex, more difficult. The trade-off there is that you're better diversified as a portfolio versus if you just buy more equities, you end up being more prone to drawdown risk. And drawdown risk in these events becomes difficult to overcome. So two paths. You could take the simple buy more risk, buy more equities. But if you do choose risk, you can do it in a diversified way that requires the use of derivatives, active management, other forms. And that's for a more complex system, I think, to go down those routes. And those are the two paths I see in portfolio solutions.
Great. I don't see any more questions, so why don't we close? Any last comments for any of the panelists at this point? Okay.
Go
Go ahead.
Okay.
I will say one thing, if you mind, is, you know, Harris School students, I think by nature are optimistic people that are willing to find solutions and roll up their sleeves to get the job done. And I think at my time there, in the early 2000s, I felt like that was one of the biggest benefits of being a Harris Schooler. And, you know, that was during that time, you know, my first year was during 9/11. And so I found the camaraderie with my colleagues, you know, other students, you know, et cetera. The school was great. But I will say, like, COVID, you know, when we're in the thick of things, it's difficult to get through. But I do think on the other side, I think by and large, life will get better. It's just we'll have to transition to what that better is. There's going to be financial bumps along the way, and it's going to be it's not going to be a straight path. But I think students like at Harris who are willing to have that belief that there's always a solution and we'll find it. I think those are the people that are needed now more than ever. And I do believe that there are solutions and that society, humankind on the other side of this will be better off in a number of ways.
Great, thank you.
And I was just going to add, Dominic, that's exactly right. I want to make sure we close this with some optimism. And I was going to say that I think, you know, at this moment, part of, because we're all, you know, have this Harris methodology that we all went through, part of what you're hearing right now is a moment of like, the data has come, right? We're kind of in the thick of looking at what the impact has been. That happens to be the moment in time we're in right now, which helps us to kind of parse out that data and start to lead to where are those solutions. And just like innovation is going to help on the private sector side, as there's going to be new innovations that are going to happen, you know, related to everything from vaccines to how we work together virtually to all this moving forward. The innovations will happen from all of you as well in the, you know, in the not-for-profit government sector, as well as, just as Dominic said, in terms of to create the path forward. So just recognize this is a moment in time. Let's use the data. It's helping to guide us on where there's going to be, you know, the greatest inequalities that exist, which helps guide us on where the need are so that we can create programs to move forward.
Great.
Yeah. And I couldn't agree more with what my colleagues have just said. I think the one thing I would add is it's really been fascinating to see how decisions are being made and policies are being created on the fly with virtually no data and in a very rapid fashion. Like, and that's just what's needed, what's been needed. But I think that now we're going to start to see a slightly slower process. Having said that, particularly depending on what happens in November, we could be entering a period of a far more muscular federal government in terms of programs and policies for the citizens. And that should be like a candy store for all of the Harris School students and alums. I think that everyone is going to be looking for how to wrap big policy ideas into the rebuilding that's going to need to take place. And that's exciting for folks like us.
I can't agree more. I'm teaching a class right now, municipal finance, and have studied it for many years. And every time there's been a crisis, out of it comes better governance at the state and local level. All the way going back to the Depression in 1930, there have been best practices that have been created out of these crises. The other thing is, my hope is that just like we have these protocols in place for natural disasters, that out of this comes protocols for dealing with this kind of the financial impact, as you were saying. I think right now everything's being done on the fly. The Fed's buying notes from governments, and as you said, checks are coming, and hopefully out of this we will have good public policy that helps us in the future, and I'm sure a lot of students from Harris will have a hand in that. So Jennifer, Marie, Dominic, I want to thank all of you for participating, and please be safe.
Thank you.
Thank you. Y'all take care.
Everybody. Thanks.
Bye.